Yeah. Very good morning in the US, UK, Europe. Good afternoon in Middle East, and a good evening in India and the rest of Asia. Plus, this finds you safe in the new normal. To esteemed speakers and the large number of overseas and local attendees, thank you for making time to be at the India Budget 2022 Opportunities in Capital Market webinar hosted by SBI-SG Securities Services Limited. This webinar has the widest diversity of distinguished panelists drawn from India's leading bank, SBI, leading stock exchange, National Stock NSE, leading mutual fund, SBI Mutual Fund, leading global custodian, Society General Securities Services, leading tax expert, Delloitte, and the Global Association of Consulting Firms, TSAC. They will primarily focus on the recently announced budget and opportunities for the capital markets and GIFT City. In this session, for the first time, experts provide a 360 view on today's topic. Though diverse, the views today converge on the above aspect with respect to institutional investors, domestic and inflow, also known as the foreign portfolio investors. This webinar is also unique as for the first time we have a global custodian, a local custodian, and TSAC. TSAC stands for the Securities Services Advisory Group. They represent the securities services perspective. Mrs. Uma will share insights from a leading custodian, SBI-SG's perspective. Before we begin, it's also necessary to share more inputs on the custody space. The India custody space is of size $2.2 trillion. It rose from $1.2 trillion in 2018 to be what it is now, with a prospect of reaching $3.5 trillion in the next 4 years. A very fast growing space. Of the 2.2 trillion, the dominant segments are FPIs at $704 billion and mutual fund at $393 billion. And another interesting topic that we will have a speaker cover is GIFT City. GIFT City will propel the growth of inflows along with other centers like Singapore, Mauritius, Dublin, Luxembourg, etc. IFSCs like GIFT City provide multiple benefits to the host country, including capital inflows and employment. Mr. Ravi Varanasi will provide the developing insights. An interesting announcement has also been made about crypto in this budget. My opinion, the advent of cryptocurrency will pave way for digital assets and more, thereby expanding the custody space. So stay tuned for an enriching, multifaceted session. Before I introduce the speakers, please note there's a chat box on which the questions need to be posted. We will have the speakers present their views, followed by the Q&A session. Now, briefly introducing our speakers for the day. Our first speaker for the day is Uma Shanmukhi Sisla, Managing Director and CEO of SBI-SG Global Securities Services Private Limited. She brings with her knowledge and strong experience of 35 years in banking and finance and business development. She has been featured in India's top 100 women in finance by Equalify in 2020. In various assignments in SBI, she has had the opportunity to develop deep sectoral knowledge of SME, Forex, corporate, credit, general banking, and training. She has had a varied experience in investment banking, having 2 stints at SBI Capital Market. She has earned many educational milestones whilst being a graduate from Osmania University, earning an MBA in Banking and Finance, Certified Associate of Indian Institute of Bankers, and is also a certified financial planner from FBSP India. Following her talk will be that of Dr. Soumya Kanti Ghosh, Group Chief Economic Advisor at State Bank of India. Dr. Ghosh is currently the Group Chief Economic Advisor. Previously, he worked at Tata AIA, American Express, and ICRA, amongst others. Dr. Ghosh has been a co-author in pioneering work to capture payroll data in India for the first time, both formal and informal, and designing the PM Kisan scheme. Following his report, EPFO and ESIC has started to give out monthly payroll data. Dr. Ghosh is a member of the working group and that has been set up by the Government of India for the revision of Wholesale Price Index. He serves as the chairman of the Indian Banks Association Economics Group. He is also a member of the SEBI Advisory Committee on Research, Insolvency Board Committee on Research, Economic Advisory Council, and a lot more. For 4 successive years, ending 2021, Dr. Ghosh has been ranked as one of the best individuals in research in India by the Asset magazine. Our third speaker for the day is Ravi Varanasi, President and Chief Business Development Officer, NSE. Ravi spearheads the exchange initiatives in the areas of market structure policy across asset classes, fundraising platforms for corporates, SMEs, and startups, education, financial literacy, and inclusion. He has earlier headed regulatory function of the exchange. Ravi represents the exchange in various committees, advisory groups of the regulator and the Ministry of Finance. He's been representing the exchange in international forums, groups. Ravi has also been with the exchange since 1995 and has wide-ranging experience in business development, regulatory, and operational roles. He has a bachelor's in chemistry and a diploma in management, and is an associate member of Indian Institute of Bankers and a certified anti-money laundering specialist. He has earlier worked with State Bank of India and the Vaishya Bank. Our fourth speaker for the day is Srinivas Jain, also known as Srini, Executive Director and Chief of Strategy at SBI Mutual Fund. Srinivas has over 28 years of experience in financial services, of which 22 years have been in asset management. Srinivas has been associated with SBI Fund Management since 2001. Prior to this, he was associated with Birla Sun Life Asset Management Company and Kotak Securities. In his current responsibilities as Executive Director and Chief of Strategy, he has multidimensional roles. He overall is responsible for strategy, global business development, and spearheads sustainability, digital and technology initiatives for the organization. In 2017, Srinivas Jain was awarded Digital Marketer of the Year, Personal Finance and Investment by AIMAI, Internet and Mobile Association of India, and Money Control. He's also profiled amongst top 25 marketers in the recently released coffee table book, The Inspiration Code. A commerce graduate from Bangalore University, he's a cost accountant as well. Nathan Deary, Head of International Coordination at SGSS. Nathan joined Society General Group's International Leasing Network Audit and Support Division in 1990 before joining FIMAT, derivatives broker of Society General Group in 1993, where he held various management positions in Madrid, Hong Kong, Singapore, Chicago, and Frankfurt. In 2003, Nathan joined Komerční banka in Prague, part of Society General Group, as head of investment banking operations. In 2007, he was appointed head of SGSS India, and in 2015, country manager of SGSS Ireland. In 2015, he joined the International Coordination Department of SGSS and became its head in 2017. He is a graduate from the Rowan Business School, also known as NEOMA. Our next speaker would be Rajesh Gandhi. Rajesh is a partner in tax practice with over 19 years of experience in diversified sectors across consumer business, financial services, manufacturing, and technology. He's part of the financial services group and leads the asset management tax practice for Delloitte India. He returned from the US in December 2012 after a 3-year stint. While in the US, he led the India desk and the International Core of Excellence program for Deloitte Tax LLP New York. Rajesh has penned articles in newspapers and international magazines on domestic and international tax issues, as well as lectured on topics relating to corporate and international tax. With over 19 years of experience in domestic and international tax and exchange control regulations, he's advised clients on various tax issues, including domestic and international planning, inbound and outbound investment structuring, amongst others. He's a qualified chartered accountant and an associate member of the Institute of Chartered Accountants of India since 1997. He's also had the distinction of being accorded 41st place all over India at the final examination of the Institute of Chartered Accountants of India. And finally, a very brief introduction about me. I'm Viraj Kulkarni, the founder of Pivot. Pivot is Asia's largest consulting company in the security services space. Prior to this, I have worked across 3 of the top 5 global custodians, of which 12 years as country head of security services with Citibank India and Switzerland, JP Morgan, and BNP Paribas. I've also been on the Asia Management Board of BNP Paribas Securities Services and regularly contribute articles on the market. Another interesting information I'd like to share is that I'm also a co-founder of TSAG, which is the Global Association of Consulting Firms in Custody Space. TSAG is present in 10 countries and is widely acknowledged for thought leadership. With these introductions, I request Mrs. Uma to make her opening remarks and take it forward.
Thank you, Viraj. Thank you so much. Very good morning, good afternoon, and good evening to all our distinguished guests and our panel of speakers who have joined us from various time zones across the globe for this very unique webinar on India Budget 2022, Opportunities in Capital Markets. SBI-SG Global Security Services Private Limited is very proud to be bringing this event to you. I thank you all for joining us with this unprecedented enthusiasm, and I'm sure that our panel of experts, introduced by Mr. Viraj Kulkarni, will keep us all well engaged with their insights on the subjects shortly as we begin the session. But before that, I would like to give some brief overview on SBI-SG Global Security Services Private Limited. This is a joint venture between 2 leading banks, one from India and one from Europe. Our strong parentage comes from State Bank of India, which is India's largest commercial bank with a balance sheet size of more than 50 trillion Indian rupees and a financial services conglomerate with presence across all financial services, be it the mutual fund through our SBI mutual fund, be it insurance, both in life and non-life through our companies SBI Life and SBI General, be it credit card business through SBI Credit Card Limited, and investment banking through SBI Capital Markets. And the other parentage comes from Societe Generale, which is one of the most prominent banks from the European Union, headquartered in France. Again, a financial services conglomerate, a global custodian, and a significant player in capital markets across the globe. And coming to SBI-SG, we are a leading provider of custodial services, fund accounting services, professional clearing member services, designated depository participant services, and all allied services for both domestic and foreign institutional investors. For the past 1 decade, we have been in this activity. And it will be our endeavor to bring many more thought leadership initiatives, offer client-centric solutions, digital-driven solutions across all the segments, be it FPIs, FDIs, AIFs, mutual funds, PMS, etc., showcasing the opportunities while assisting in addressing the challenges. I would be delighted to hear from you of how we can support your initiatives. We will also keep you posted on our proposed footprints in the GIFT City, which is a fast-growing jurisdiction. Over the years, we have scaled new peaks, crossed several milestones in our business, and currently we are servicing an AUC of $160 billion and assets under administration of around $120 billion. We have also been rated by the Global Custodian. We are the only custodians to offer investors the choice to select from 3 models of relationship: contractual models for local custody, master custody, and global custody agreements. To the best of my knowledge, no other custodians provide such flexibility to inflow-outflow investors. We support this flexible operational model for custody, clearing, and settlement. As India aims to be a T+1 country, we at the SBI-SG are offering diverse solutions. While in the digital age, many goods and services become virtual, asset managers and asset owners, corporates and banks will still need on-the-ground physical presence from their securities provider. In major markets, it constitutes a high-level market expertise, increased asset safety, and the ability to be the voice of the client in the market. Our local presence adds edge to this offering. Being a leading market participant, market intermediary, and serving institutional clients, we are naturally interested in looking at what the Indian capital markets have to offer our clients and how the budget announcements will impact capital markets. As we meet on the 3rd day after the budget announcements, it is already in our knowledge that the market's immediate response has been positive to the budget 2022 announcements. And not just that, the bears that were ruling the market the week before the budget announcements temporarily went into hiding. But of course, there will always be ups and downs due to profit booking and re-entering into the market. So that's normal way the markets move. In fact, Indian capital markets have returned more than average returns globally in the past 2 years. And the participation in the capital markets is well balanced across different classes of investors and adding to the depth and maturity of the markets, aided by both forward-looking, growth-oriented, and risk-mitigated regulations and reforms that the regulators have been bringing in. India Budget 2022 has definitely come about as a growth-oriented budget, as expected. But how should the investors interpret the announcements and the nuances of the same will be presented to us by our esteemed panel. So let's tune into them and listen from them. Once again, my heartfelt thanks to all of you for joining us. And now let the limelights go on to none other than Dr. Soumya Gandhi Ghosh, the Group Chief Economic Advisor of State Bank of India, for his macroeconomic perspective and the budget 2022. Thank you so much.
Yeah, thank you, ma'am. And it's nice to be with all of you. And thank you also for the opportunity and the time given to me to speak about the Union budget. What I will do in the course of the next 15 minutes is that I will make a very short presentation. I think we'll share the copy of the presentation with you at a later point of time. But as of now, I will just give you the messages from the PPT. There are, as I do most oftenly, the budget has a lot of the PPT has a lot of numbers inside it. So you can actually take your leisure time and go through the numbers and and see in your own and have faith and believe in your own eyes about India being an attractive investment destination, and how the budget actually proposes a story which is futuristic in vision and completely growth oriented. So that's the message which I would like to give out, and I'll put you with some numbers which will be helpful for you in understanding. Just give me 1 minute as I share my screen. Okay, I think my screen is now visible. So I can just start the presentation very quickly. The first thing is that the first thing which I'll talk to you about this presentation is just 1 second. Okay. Now the first slide is that I would like to say you something very important. Don't look into the figures, but think about some of the change in the behavioral habits which is actually happening in the Indian economy, which could potentially drive growth. The first thing is that when the budget was being presented on the 1st of February 2022, on 31st January at 5:30 p.m., CSO had released the data which was revealing in nature. What did the data show? The data showed that there was a lot of story going on that Indian households are in distress. But when the actual data came out in FY21, March 2021, we found out that the total gross financial savings of the household has jumped by a massive 7 trillion. That is a historical record at any point of time in the course of the India's fiscal, and 7 trillion rupee. And as you know, if you take the exchange rate of 75, you can find out the corresponding number in US dollar terms. And the important point is that the Indian financial liabilities of the household has only increased by 0.18 trillion. So as a percentage of household debt, which is more important, household debt currently is only at 35.8% of GDP, which is the lowest across all countries, just higher than South Africa. But as you can see in the graph, all other South Asian countries, including China, and of course the developed countries, are actually much higher in terms of the household to debt to GDP ratio. So that's the first thing. So the story of a significant increase in household debt during pandemic has now turned on its head, thanks to the data which was released by NSO on 31st January 2022. Next, let me give you another number which is interesting. If you look into the private final consumption expenditure of Indian households, I'll give you these numbers in US billion for a better understanding. But the important point to note is that during the pandemic time, people actually were sitting at home. So this is again a record. For the first time in the history of the private final consumption expenditure, the household had spent an additional 3.5 trillion on food and alcoholic beverages in 21. There was a complete collapse in spending on clothing and footwear, then furnishing, transport, restaurants and hotels, miscellaneous goods and services, everything. So ultimately, the total consumption expenditure declined by 2.8 trillion, but actually it increased in food and alcoholic beverages. That is an important thing to note, because that actually had a sobering impact on the inflation number. What has happened is that people were sitting at home, and given the fact that government and the RBI have ensured a supply management was properly dealt with as far as food is concerned, that's why inflation has been largely under control. And we believe that inflation has been under control. Possibly there could be a story on inflation, but I will not spend much time over here. I want to be short. So these are the two things which you must remember when you're interpreting the budget numbers. Now, what are the budget say? 4 focus areas. Gati Shakti means infrastructure, inclusive development by, that is the term which the government uses, Sabke Saath, Sabke Vikas, Sabse Vishwas. That is taking everybody along and having the faith of everybody. Financing of investments, productivity enhancement and investment, sunrise opportunities, energy transition, climate. So these are the 4 main areas of the priorities. Now, other important point is that the PLI actually has been quite playing up so well. India has, in the last year, India, as you know, has set up an export target of 400 billion. Now, from China, we import, our import bill, if around 65 billion we import from China, of which 39.5 billion is in commodities and goods, and where the PLI scheme has been announced. So we just did a small simulation to find out that even we became Atmanirbhar in these areas where we are importing from China. For example, if we cut our dependence on China, even to the extent of 20% of this 6.5 billion, then we can add around 8 billion to our GDP. And if we reduce our dependence by 50%, we can add 20 billion to our GDP. So this is the potential of the current PLI plan, and this exactly gels with the Prime Minister Gati Shakti focus and the India's focus on manufacturing, which the budget actually has been doing significantly. So this is one more thing which I wanted to share. The other, these are all the agricultural, there has been from now a new type of Kishan drones will be used for crop assessment, but agriculture, the government is making all out efforts to move into an agricultural value chain. The other important thing is that MSME enterprises, as you know, it basically supports 29% of India's GDP, has the largest employer base in here, and the government has actually helped the micro, small and medium enterprises significantly. 113 million MSMEs were provided additional credit by the banks, and we at State Bank of India recently did a study to understand how the credit guarantees program, which is called the ECLGS program, which the government has launched during the pandemic, how it helped them. We found out that it actually helped 13.5 lakh SME units, that is 1.35 million SME units from surviving during the pandemic, and it saved around 15 million jobs. So this is the potential of which the micro, small and medium enterprises have helped, and government has actually said that it will going to handhold the SME sector in terms of extending credit to the ECLG scheme, and also additional credit under a credit guarantee scheme, which is commonly called CGT SME. As all of you know, we have also suggested to the government that the government should think like the likes of the US Small Business Association, Small Business Administration, and possibly there could be some decision on it. The committee has been formed. Hopefully we'll hear about the committee in the future. Very quickly, there's a major thrust to infrastructure. Data centers, energy storage system has now been given infrastructure status. That's a huge thing. The existing special economic zones now will be replaced by a new law. I think I am very excited about that law, because this has been in the pipeline now for the last 10 years. And finally, we may see the light at the end of the tunnel. This is the infrastructure focus area. Health is there, water supply is there, housing is there, road transport is there. Parvatmala basically is there. Basically, is that road. I mean, in the hilly areas, you will have this ropeway. Northeast region, the government is giving special focus, and of course the renewables. In the renewable space, the government is going to spend an amount of 195 billion in solar PV module manufacturing, which has now also been bought under the PLI scheme. So this is all infrastructure focus areas. This is the financing pattern of infrastructure. 111 lakh crore is the total financing national infrastructural program which the government has planning to roll out over a period of 5 years. The center share is around 40%. So the center needs to spend at least 7 lakh crores every year. This year it is spending 7.5 lakh crores. The government also has a large monetization plan. You can see over here, it is 82 trillion. Out of 82 trillion, it could create and demand for credit from the banks to the extent of 37 trillion. So you can see that the banks are significantly well placed to fund this infrastructure journey of the government. And the government has already launched the National Bank for Financing Infrastructure and Development, which will be also supporting government's endeavor. Now, this is one thing, the digital banking, the scheduled commercial banks to set up 75 digital banking districts. It is something in process, so we'll talk about it later. Now, what are the budget summaries? The first thing is that the FY22 budget numbers for which will end in March, the figures look conservative. Let me give an example. This table, on the first table, there are two columns. The last column shows what is the average amount realized in the fourth quarter of every financial year when the item under consideration. Take the example of income tax. Income tax, we have seen over a period of 5-year history that of the total collections which the government budgets to achieve during a year, nearly 39% is achieved in the fourth quarter. But this time the tax collections are so bad, the government needs to collect only 27%. Similarly for union excise duties. And revenue receipts, the government only has to mobilize 16.6%, which is much lower than 34.4%. So to cut the long story short, I think the FY22 numbers seem conservative. If the FY22 numbers seems conservative, 6.9%, obviously if the FY22 budgeted numbers are achieved and it is more than the budgeted, then the FY23 numbers also will be lower than what has been projected. So this is basically one important thing which has to be kept in mind. The incremental fiscal deficit shows budget projections are reasonable. Exactly these numbers I'll share with you, then you can go through. But the point to note over here is that exactly the expenditure increase is mapped by the revenue jump. The only point to consider over here is that the government is going to, last year there was a significant jump in small saving by 2 trillion. And so the government had to borrow less from the market of around 1.5 trillion. This year, the government is considering and that the small saving collection could actually decline by 1.7 trillion. So they actually have decided to increase the market borrowing by 4 trillion. But I think we have spoken to the government on this, and the FM yesterday, as I am speaking to you, the FM is in fact giving an interview, and they have come on the channel and clearly said that the borrowing numbers in this year could be lower than the budgeted. And as we give you some examples, the small saving collections are unlikely to be lower this year as anticipated in the budget, because there are some things which the government has decided to do in the budget which are extremely important. For example, the government has now decided to link the 1.5 lakh crore post offices with the core banking solution of the bank. This is the tax buoyancy. Again, you can see the number is reasonably estimated 0.9. Last year was 1.4, and it is much lower than last year. So I think again here the government has reasonable revenue numbers next year. Tax revenue, we can all see that these incremental numbers are much lower than what it was last year. So, and the best thing is that GST collection, we are moving towards the target of 1.5 trillion. I can assure you that the government target is 1.5 trillion. It could move up to towards 1.6, 1.7 trillion towards the end of the year. And if it moves up to this year, the next year could actually see that some concessions being offered on the income tax front. Because I think there has been a lot of demand in the Indian context always. The government's disinvestment numbers are also reasonable because they will do the LIC this year, but next year I think they will do the BPCL. So the target for next year is also reasonably estimated at 65,000 crore, which is 0.65 trillion. And this year the number was 1.7 trillion. It has been moved down to 0.78 trillion. So this is basically the math. So all the numbers are reasonably estimated. Expenditure, the government capital expenditure is supposed to jump to a massive 7.5 lakh crores. It includes 7.5 trillion. It includes 1 trillion of the states. But all this capital expenditure also includes the off-balance sheet activities, which has been now brought under capital expenditure. And that means that the budget should be commended for the cleanup act, which it has been doing for the last 2 years. So whatever is presented in the budget gives you an idea about the indebtedness of the government, and the markets actually must towards such fiscal transparency when India has embarked on the, even though fiscal consolidation has been slow, but the fiscal transparency has been the buzzword in the last 2 years, which the government must be commended. As I said, deficit to borrowing, the total borrowing requirement, unfortunately, of the government is around 24 trillion next year. And as I said to you, and as I will say in the next slide, is that these borrowing numbers could be grossly exaggerated. Small saving collections next year is targeted at 4.2 trillion. You know, in FY22, it was 6 trillion number, from where it has been targeted only at 4.2 trillion. I think this is an estimate which is on the lower side, because core banking solutions of banks will be linked to all 1.57 lakh post offices. As on 31st March 2021, there had been 8.2 trillion deposits in post offices. So once these deposits are all linked with the bank accounts of the people in the rural areas need not have to go to the bank. They can do a seamless transactions. And our sense is that this will lead to better financial inclusion. This will also lead to the fact that the borrowings from the market will be less, as if this 8.2, even if say 10% or 20% comes to the banks, or it goes from there, it goes out, to these deposits, you can see that what is the potential of an upside in the small saving, which will curtail the borrowing rates. So please don't go by the borrowings which has been said. And the state finances this year has also been very good collections as we move along. There has been progressive decline in extra budgetary borrowing. I have not inclined, and this is the best thing. The government has reduced everything from extra budgetary resources from the resources. What is now available is now everything is now available on the table. So this is the my sense is that the government is moving in the best possible direction in terms of doing this exercise. These are some of the sector-specific arrangements: master plan for expressways, multimodal logistic park, Prime Minister housing scheme. Every ghar, har ghar nal se jal means every ghar will have a tap water. 3.8 crore households to be covered in 2023. That is 38 million. This is a massive program. Allocation of the Ministry of Road Transport Highways 1.12 trillion. Ministry of Railways 1.4 trillion. 400 new generation Vande Bharat trains which will be commencing in India. Ropeway development plan, Ministry of Defense, battery swapping policy, shift use of public transport in urban areas, higher capex spend by the government, and to facilitate domestic manufacturing of solar modules, an additional amount of 0.19 trillion has been made. And this is basically the most important, exciting thing. The RBI is going to go for a digital rupee. There are till December 2021, there are 87 countries who are who are exploring a CBDC. 14 countries, including China and South Korea, who are now in the pilot stage with the CBDCs and prepare a possible launch soon. So imagine India, the country of 130 crore, 101.3 billion population, moving to a digital, somewhat digital currency in the near future. So once next time when you come to India, everything could be digital. And this is one thing which we are extremely excited, although it will has both opportunities and challenges, because if digital currency is introduced, banks are a source of financial intermediation. So banks will face pressures, but there is also opportunities to the bank, significant opportunities to the bank in terms of business opportunities like digital. And today, logically speaking, everything apart from M0, everything is digital today. For example, whatever, if you just think of an balance sheet of a company, wherever the balance sheet is published, you publish the numbers, and if, for example, if the State Bank of India keeps has a reserve with the Reserve Bank of India, it doesn't mean that it keeps the reserves every day, goes and deposits the cash over there. Everything is done electronically. So it is just saying that everything of it will be electronic, and in the future this actually will be very important. And if the remittance, the World Bank estimates that cutting fees to 2% could give a 16 billion year boost to remittances to low-income countries. So this is some number which we should be cognizant of. And finally, I would like to give you one model over here. I think in the third wave, every day third wave was as bad as the second wave in terms of the number of cases. But do you know that the Indian vaccine has worked so well? We did, and I will not get into the model, we did a small model, and to find out from the 20 major states that if suppose there was no vaccination available to India, you have actually avoided around 93,000 deaths during the third wave, which would have occurred without the vaccines. So the third wave has come and also will be gone. Possibly the pandemic will start into an endemic. And as I speak to you, we beckon that the next fiscal year could be a very good growth opportunity on the part of India, because a large part of the growth in the fourth quarter of this fiscal has shifted to next year because of the Omicron. So the budget actually is a very good budget in terms of a futuristic vision. Of course, there could be some discussions on inflation, some borrowings, which is happening in the market. But I think over a point of time, if growth comes back into the system, all of us would be happy. And it is only through growth that could give support to the middle class in India. You know, all of us are middle class in India, and that's the term which is quite often used. Thanks to all of you, and I'll be happy to take questions after the discussion is over. Thank you.
Over to you, Ravi.
Yeah. Good evening, good morning, good afternoon, good evening, everybody. After that interesting presentation from Dr. Ghosh, he has touched upon almost all the major areas of budget. I just initially just wanted to thank SBISG for giving this opportunity to be with you all. The defining feature of this budget is essentially supporting capital formation to guide the economy through the recovery till private investment kicks in. The finance minister did mention that the virtuous cycle has to happen. So they are kickstarting using significant capex from the government and hoping that the private sector will follow fairly quickly. The uncertain focus of this budget is obviously on the growth of the economy. FM has proposed pump priming with increased capital expenditure as a principal vehicle for getting the virtuous cycle going so that it will result in increased growth as well as job creation. This increased capex without incremental channels of revenue could keep the fiscal math stretched for a little longer period, but I believe we're on track of for the FRBM target of 4.5% fiscal deficit by FY26. Budget manages to push for growth at a critical time when the pandemic is still around, inflation is high, and aggregate demand continues to be weak. Share of capex at 19%, obviously significant focus, as Dr. Ghosh also has mentioned, is on the capex. It's almost at 19% of the total expenditure. This is the highest since 2000. So the entire focus, entire economy, energy, everything has been put behind capex and infrastructure, particularly to ensure that the economy grows and kickstarts the investment cycle. Another unique feature of this budget is enhanced and issue-based fiscal space it chooses to give to states, allowing for greater autonomy in charting out the growth path. Not only the center, the state governments also will be able to manage the show. Finance Minister also provided a blueprint for the 25-year trajectory from India at 75 to India at 100, what she called the Amrit Kal. The nominal GDP for FY23 has been pegged at 258 trillion rupees. That's almost 11.1% year-on-year growth. It is not very clear how this squares with the higher inflation and our requirement to grow the economy at around 8 to 9% to ensure that India continues to grow as is expected. The FY22 fiscal deficit at 6.9% is marginally higher than the budgeted number, but FY23 deficit has been pegged down at 6.4, which is the result of, essentially the kind of money which is coming into the capex obviously has pushed the number up, but it is still a manageable 6.4%. Net market borrowing is up by almost 43%. Dr. Ghosh also has talked about this, almost 14.9 trillion rupees. Policy normalization over the next quarters is likely to maintain pressure on yields across term structure. We will have to really wait and see a revival of private sector capex, especially in an environment of rising cost of funds locally as well as globally, to spur domestic demand and revive employment opportunities and conditions in India. Net tax collections in FY22 will surpass the budgeted estimates and almost touch the almost an 11-year high of 23.8%, thanks to faster than expected economic recovery, leading to higher tax buoyancy. Income tax regime remains stable. Hardly any changes have been announced, both for individuals as well as corporates. There was a minor tinkering on the surcharge on capital gains. I'm sure Rajesh will talk about that, this particular aspect in detail. This obviously addresses the demands of the startup ecosystem, the private equity and VC space. They have been asking for the tinkering need to be done so that they'll benefit. A few customs duty changes have been made. Otherwise, the tax system has been exceedingly stable. Whatever small changes which have been announced are essentially to give greater reliance for domestic manufacturing. Tax is proposed on digital assets, while we still await legal and regulatory framework to fall in place for cryptos. Incidentally, non-tax revenues have gone up by almost 51%, which was mainly due to the windfall gains from higher than expected profit transfer from the RBI and higher telecom revenues due to prepayment of deferred liabilities by telecom operators from previous auctions. This additional revenue has actually cushioned the increased capex and enabled the government to keep the fiscal deficit number at a reasonable stage. Performance on the disinvestment has been a little lackluster for the FY22. The revised estimate has been pegged down at 780 billion versus the budgeted number of almost 1.75 trillion. LIC IPO, which is expected to hit the markets shortly, should help achieve the number. FY23 budgeted number has been kept lower at 650 billion. Markets already are talking about BPCL, BEML, SEI. Multiple candidates are being looked at for the disinvestment in FY23. Spending on social programs remains intact. That's a key component of ensuring that the needy are getting the right share in the growth. NREGA, PM Awas Yojana, Swachh Bharat Mission, PM Krishi Sinchal Yojana, they're all getting the share. With about 51% of the population fully vaccinated, the focus is now on overall well-being. Water and sanitation has seen almost a 32% year-on-year jump in allocation. The budget aims to provide tap water to additional 38 million households over and above the current 87 million. So the focus is on ensuring overall health of the population. On the markets front, there is an interesting proposal for issuance of sovereign green bonds for funding public sector green projects. This is a big plus and will give a fillip to sustainability projects and will help in reducing carbon emissions. Government's focus will should be further augmented by the private sector's initiatives in this area. Further on the green front, FM also announced setting up of service infrastructure in GIFT City that would facilitate global capital actually, idea is to facilitate global capital investment in sustainable and climate assets in the country through the GIFT City route. She's also talked about setting up of international arbitration tribunal in GIFT City for settlement of disputes. This is again a step towards ease of doing business in GIFT City. Tax breaks for ODIs issued by the offshore banking units for non-residents would also give an impetus to the GIFT City. While on the GIFT City, these are the budget proposals which have been announced in the budget. But we think GIFT City, Viraj also has mentioned earlier, GIFT City is going to be the staging area for India's the flows into India and flows out of India. And there are lots of initiatives which are happening. GIFT City received the biggest boost when the regulator has been set up in GIFT City. An autonomous regulator has been set up in GIFT City towards the end of 2020, IFSC authority. Post that, we have seen a significant amount of activity happening. From the NSE side, as you're all aware, we have an international exchange in the GIFT City. We are trying to actually shift the entire liquidity in Nifty trades on SGX. Most of you are aware of it and possibly are participating in Nifty in SGX. We are setting up a connect structure between NSE IFSC, which is our international exchange in GIFT City, and SGX, and which will actually transfer the entire liquidity on SGX in Nifty to GIFT City. We are at an advanced stage. All the regulatory approvals are in place. We have the software and other facilitation is currently happening, and we expect SGX has already set up a special purpose vehicle in GIFT City for making this connect work. And we are hoping that this connect structure should be in place in the next 3 to 4 months period, at least the basic operations will commence, and fully operational over the next 2 to 3 months after that. That's where we are. And we are excited about GIFT City, and there are multiple other initiatives which are being planned with GIFT City as the center for almost everything. We're also looking at a possibility of converting one of our entity in GIFT City as green exchange for taking care of all sustainable finance related issues. There's a huge amount of focus on that side. We're also coming out with a series of exciting products for Indian residents trying to reach out to international markets and international investors coming into India. And that's as far as is a sideshow, not directly related to the budget. Again, on the startup ecosystem, India's startup ecosystem is almost third largest in the world. On the back of significant PE/VC investments close in 2021, close to $77 billion have been invested, which is almost a 63% rise compared to previous year. To encourage this sector, a committee is being set up. Finance Minister has announced setting up of a committee which will advise appropriate regulatory measures for scaling up PE/VC investments. A significant chunk of capex is going to infra. Obviously, that is a focus. One of the key pillars of the budget is PM Gati Shakti, which envisages improved multimodal physical infrastructure along with efficient logistics to support growth path laid down over the next 25 years. There is emphasis on clean energy, EVs, supporting infrastructure in terms of battery charging and battery exchange. Another interesting announcement is the CBDC, which Dr. Ghosh also has mentioned. RBI is expected to come out with a digital rupee in this financial year itself, which could further strengthen and revolutionize the payment systems. Connecting post offices to the core banking system is another significant step in broadening and deepening the financial inclusion agenda of the government. SMEs have received significant support in this budget. They have taken the huge brunt during this pandemic. Budget has come out with series of announcements, a RAM program with almost 6,000 crores for efficiency enhancement, extension of ECLGS by 1 year, with almost extended coverage of 50,000 crores exclusively for hospitality and related enterprises, and additional 2 lakh crores for CGT MSE. These interventions should help MSMEs tide over the especially a difficult situation which they found themselves during the pandemic. All in all, the budget's unstinted focus on delivering growth and creating a virtuous cycle of investments should help the economy come out of the pandemic situation with flying colors. That's about from me. Thanks. Over to Srinivas for his comments.
All right. Thank you. Thank you, Ravi. Good morning, good afternoon, and good evening, everyone. Let me thank SBI-SG for organizing the webinar and inviting us to share our views. While Dr. Ghosh and Ravi have given some insights about the budget, I will focus on the impact on the capital markets and, more importantly, outlook for the broader asset classes, and that will be very helpful. But first, we need to understand the context of this budget. We were going into the budget with a decent economic recovery. We've seen a post-COVID recovery significantly despite new waves. Beyond the contact-intensive sector, the entire economy is kind of back to the pre-pandemic kind of days. So overall, we see the confidence in policymaking has got much more better, and some really big uncertainties are kind of behind us, especially with the success of vaccination drive. It's really helping policymakers think big, like what we saw in this week's budget. Making really ambitious plans. In fact, the government was all about ambitious plans. If you look at our CEO actually wrote a piece on Times of India yesterday, and he titled it "Blueprint for the Amrit Kal Vision for the next 2025." But the fact is, this government has been talking about it for a while. In the next 5 years, in the next couple of years, and the last couple of years, I think the trend to modernize, trend to invest on infrastructure, trend to keep the growth momentum going is going to be the theme, in the budget. In fact, Mr. Ghosh showed a lot of interesting data cuts on the borrowing program. So I'm not going to repeat some of the key ones, but I will talk a little bit about the ones that affect the capital market. Firstly, I think the last year fiscal deficit being marginally overshot was kind of known, but the numbers are definitely a little higher, higher than the budgeted expenditure of around 2.9 trillion. The government also overshot its receipts target, which was good, because in the last couple of months we see the buoyancy in the revenue number. This despite they not doing very well on the disinvestment target, right? So this has come mainly around 2.2 trillion from tax revenues and around and about 700 billion from non-tax revenues, right? So it's a good sign that at least the buoyancy in revenue collection is actually going up, and that will give a lot of confidence to the government. Even though I think the government has been very conservative in their tax assumptions front. This year alone, I think we still got this month to go, this and next month to go. I think our estimate is another $500 billion rupees worth of additional tax revenue, gross tax may get collected beyond the budgeted. And of course, next year, I think there is a potential to look at another 1.5 to 2 trillion additional revenue, subject to, of course, crude doesn't fall back, and the crude kind of falls back to the 75 range that the government is indicating, and we don't have to worry about a big excise duty cuts. When you really look at it, I think one of the good news in this budget from our point of view is that while interest expenses are going to go up, and that is continue to be the case, the subsidy bills are continuously coming down. I think it's a good trend from productive versus unproductive expenses, right? The pro-growth spending is, I think, very positive when you look at this budget. Investments in railways, renewable energy, water sanitation, defense, all these are very, very key. And these kind of investments are significant when it comes to both capital markets companies that are invested and, of course, the economy as well. But, of course, the downside to all this is the government borrowing program, which is expected to be 14.3 trillion next year. This definitely came in higher than the market estimate of 12 to 13 trillion. So the net borrowing is also estimated to be around 11.2 trillion, which is higher than 9.3 trillion this year. But I think Mr. Ghosh already talked about some, and also Ravi also talked about some of the key drivers. But I think the key drivers to the capital market will be this big Gati Shakti master plan on the road. I think there is a lot of legs on this, and this has a lot of momentum both from the bond market and the equity market. The digital rupee that Dr. Ghosh also gave a very interesting insight could be a significant multiplier effect as and when that gets introduced. Housing is a very interesting project. This government has been driving housing, $480 billion rupees allocated again on 80 lakhs housing in this next year is a very big plan, especially in Northeast, focused on development infrastructure, social infrastructure is a big positive. In the realms of the financial sector, the announcement of digital integration of post offices with core banking system, that would think will enable financial inclusion. And that financial inclusion, especially things like online transfer of funds between post office bank account and other bank accounts, this will create a big multiplier effect, which we have already seen in what's happening with the urban digital growth that's there. Another landmark space, discussion that's going on, whether it's, the question today is taxing cryptocurrencies or virtual digital asset at 30% fair or unfair. But I think it's a cognition that the government has given towards digital currencies and digital assets is at least a first good starting point. We'll have to see how the regulation shapes on that. I think besides all this, I think the discussions around climate change, the introduction of green bonds, these are all fantastic initiatives. These are future-looking initiatives. These initiatives are something that all over the world people have lauded. So let me come to our market outlook point of view, right? At this point of time, the economic growth continues to be very strong. Any uptick in profits to GDP could lead to non-linear uptick in earnings over the next few years. Our fund house view is that we are in the early stage of earning upcycle. Even as investors can do well to moderate the return expectations from 2021 levels. Near-term risk continues to be stretched regarding equity market sentiments, but we continue to advise our investors that whenever there is a significant pullback, there is an opportunity for you to look at pro-economy assets to be put in your portfolio. On the bond market, it's a little different view, right? Our concerns are, especially with aggressive monetary tightening happening globally, the sell-off on global bonds, push for higher yield, and of course the local borrowing program is a little bit of a concern for the bond market existing investors. So we already saw that post-budget yields kind of inch up 15 to 16 basis point on benchmark. The borrowing program was a shock to some of the market participants. But I think overall, it is a positive thing and we will go over it at some point of time. Well, one of the key things that we missed is any kind of discussion on the market stabilization scheme that has been talked in the past. In fact, if for not want of that today, we may still have to go for unfriendly measures like OMO sales, which have direct impact on yields on the market. We continue to be cautious. We don't expect interest rates to come down. At least we expect this to be stable, and in fact over the period of next couple of years may even strengthen or go up. So we will be cautious on the fixed income side. Let me stop here. I'm happy to take questions after the discussion. At this point of time, I'll hand over to Mr. Nathan. Thank you very much.
Thank you, Srinivas. Hello to all. Bonjour. Namaste. I am in Paris, not in the stratosphere, but I was invited to give a global view of the foreign investor. So I put myself from this in the. First, I would like to compliment Mrs. Uma, the CEO and MD of SBI-SG, for organizing such an expert panel, and to thank her for inviting me to share my thoughts on this important topic. I would also like to share that I have been associated with SBI-SG since its inception, when discussions started between our two groups in 2007-2008. At that time, I had been seconded to India, happily I must say, to set up our operations together with colleagues of SBI and to launch our business. And I must confess that from then onwards, this JV and India in general are particularly dear to me, hence my pleasure of being with you today. Now, years after, starting from this blank sheet, I am delighted and proud to see the achievements made by our teams. We have become a main player on the market, as it was highlighted by Mrs. Uma in our introduction. And I believe that we are fully equipped for further dynamic growth in this thriving market as we combine the best of local and global. First, the unparalleled local business insight of SBI, together with the global security services expertise of Societe Generale. Indeed, SGSS is among the top 10 global custodians worldwide, with over $5 trillion of assets under custody, and a sub-custodian network in more than 80 countries, of which 18 are proprietary, India being one of them. So this global-local combination is a unique feature in our industry in India, and it gives us the conviction that we can accompany our clients at best. Now, speaking about the environment, the ease of doing business has significantly improved in India over the last few years, and possibly decades, thanks to the continuous policy developments that we have witnessed. In particular, in our industry, the SEBI regulation 2019 has truly made FPI life simpler, which was reflected by the acceleration of the FPI investment in India. We have recorded the highest FPI inflow in the financial year 2021. In my view, This investors' interest is far from tiring, with a current level of GDP growth at 6.5% and the prospects to reach record level of 8 to 9% growth next year. In this context, the current budget brings, in my opinion, even more good news for the Indian capital markets and its attractiveness. Here are a few concrete measures, among many, that have captured my attention. First, from a foreign investor's perspective, it is very interesting to note that the government is committed to encourage important sunrise sectors such as climate action, deep tech, digital economy, pharma and agri-tech. Also that it will promote thematic funds and the funds being managed by private fund managers, where we see endless opportunities. Second, initiatives as Gift City should be channeling further investment flow to the country. And by the way, I would like to praise the fact to allow world-class foreign universities and institutions to offer courses in Gift City relating to financial management, fintech, science, technology, engineering, and mathematics. It is a smart move to facilitate availability of high-end human resources for the financial services. Third, the Digital Rupee initiative underlines the intentions of India to stick with the latest technologies in finance, as it will be introduced starting 2022-23 by using blockchain, among other technologies. India already hosts 15 to 20 million crypto investors, and I suppose that we are still in the early days. And last, the launch of the next phase of the initiative, Ease of Doing Business, EOBB 2.0, evidences the ambitions to use simplification levers to foster the growth. All of the above, together with the proposed T+1 settlement rollout, which should increase liquidity and reduce the risk of non-payment or non-delivery of shares, are emphasizing the strong dynamic in India to support capital market, to enhance ease to operate, and in fine, to attract further international investment. In conclusion, for me, there is no doubt that India is well positioned to benefit from its abundance of young population and talents, attractive returns, trusted regulatory environment with strong governance, and market infrastructures geared towards the future. There are certainly challenges to keep up with the pace of change and sometimes with the complexity of the environment. But overall, I mostly see the vast opportunities. Together with our partners in SBI, through our JV SBI-SG, we are keen to be an active part of these changes in the Indian capital markets and to pursue our continued focus to provide world-class services to investors. Thank you. And with this, I leave the floor to Rajesh.
Nathan, thank you very much, and a pleasure hearing all the listeners. I'll now talk about some interesting and some maybe boring stuff on taxation for the next 10-15 minutes. And a warm good afternoon and good evening to all our listeners. This budget, what has been unique is that the government has not tinkered with tax law changes significantly. In the past many years, I remember since about 20 years or so, the budget used to be a big exercise for us for understanding tax law changes, for making huge publications, spending overnight in the office and even the next day, afternoon till afternoon. But in the last 2-3 years, I think And rightly so, the government has resisted the temptation of making a lot of changes in the budget. And this provides some kind of a certainty to taxpayers or investors. And they can, move ahead with their day-to-day matters in a more clarified manner, because making changes every year results in change of business plans and can sometimes frustrate investors. So continuing with the trend in this year, it's also there have been no changes to the tax rates, whether on capital gains or business income. There was a lot of apprehension that the government might introduce taxation on the super rich, whether in the form of inheritance tax or wealth tax or a higher surcharge. But there's been no announcements on that, fortunately. But let's speak about some of the changes which did happen, and some of them are interesting and will impact capital markets. The first one relates to an introduction of a new provision of bonus stripping for investment in shares and units of REITs, InvITs, and mutual funds. Today, a bonus stripping provision is already in place for investment in units of mutual funds, but this has now been extended to equity shares and REITs, InvITs, and AIF units. And what this provision essentially says is that if you buy an asset before 3 months, within 3 months from a record date, and you sell that within 9 months after the record date, then the loss which arises on the asset, and normally there would be a loss because the price of the asset falls after the bonus date, that loss will not be allowed to you against the shares or the assets which are sold, but it will be carried forward as a cost of acquisition of the bonus shares. So essentially, the government is averaging out the cost between the original shares and bonus shares, but they have not done it in a holistic manner for all assessees or taxpayers, but in a limited situation where you buy within 3 months and then sell within 9 months after the record date. Now, this results in certain nuances which I want to point out. One is that in the earlier regime, you could have a capital loss, which you could have used it efficiently to offset any other capital gains. So let's say you have a short-term capital gains, short-term capital loss on equity through the bonus stripping or before the bonus stripping. You could have used it for your offsetting the derivative gain, which is taxed at a higher rate of 30%. But now, unfortunately, you cannot do that, and you have to carry forward that loss against as a cost of acquisition to the bonus shares. Let's look at a small example, maybe a simplistic example on how this would work. So an investor purchases 100 shares of company X on April 1, 22 at a cost of 1,000. Company announces a bonus of 1:1, so investor gets 100 shares as bonus. In May, which is within 9 months from the record bonus date, he sells the original 100 shares at 600, the X bonus price, and therefore has a loss of 400 per share, resulting in a total loss of 40,000. In the pre-amendment scenario, that 40,000 would be capital loss, and I could have offset that against any income. But now in the post-amendment scenario, that 40,000 becomes my cost of acquisition of the bonus shares. Now, there is a bit of an ambiguity and difference of interpretation on how this 40,000 would be treated based on the language of the law. So, for example, if I in this example, I'm retaining all the 100 bonus shares, but let's say I don't retain the entire 100, but I sell 99 out of the 100 bonus shares. Now, logically, I should be allowed to claim my capital loss to the extent of 99:1 because I'm only carrying forward one bonus share. But the way the law is worded, it seems that even if I retain one share and I don't sell it, then the entire 40,000 loss in our example will be attributed to that one bonus share, which may look a bit illogical, but that's the way at least the wording of the laws seems to give an interpretation. So that's an important change, and obviously will require some calculations to be done by investors and their chartered accountants into their system. So that's on bonus stripping. Moving forward, there, and as you would have heard from the earlier conversations with Ravi and everyone else, this is a feel-good kind of a factor because the government has been giving a lot of impetus to IFSCs, to the GIFT City, both from a regulatory and tax perspective. And to my mind, the government has actually done a lot of things which they could have done to their maximum to promote various kinds of activities in GIFT City, whether it is banking, insurance, broking, fund management, and GICs or back office companies, etc. And to further to that objective or frame of mind, in this budget, there have been a few announcements. One relates to the P-note business, where the provision now says that if an investor subscribes to ODIs or other kinds of ODIs such as P-notes or other kinds of ODIs like total return swaps issued by a bank in the IFSC, then the investor, which is a foreign investor, will not be subject to any tax on the gains from such ODIs. Neither will the bank have to withhold any taxes. Again, a few things which come out from this. One is that unlike a P-note issued by an offshore broker-dealer where the issuer need not be a bank, in the case of IFSC, the issuer has to be a bank, an Indian bank, or a foreign bank which has a banking license in India and sets up a branch in the IFSC. And so other institutions such as AIFs or portfolio managers are not permitted for now to issue P-notes. Maybe they'll be allowed in future. But nevertheless, I think this is an interesting development and we might see more action in the IFSC in terms of not only the P-note business, but also other kinds of derivatives such as NDS, where there's already been a framework allowed by the tax authorities. The second comes out of a representation made by a small set of investors or stakeholders, where they had asked the government to give an exemption to foreign investors whose portfolios are managed by a portfolio manager in the GIFT City, on the basis that the investments would be made in foreign securities, and just because the portfolio is managed by someone in the GIFT City, why should that income be taxed in the hands of the investor? So the government has accepted that representation and provided this exemption subject to a few conditions. One is that if the foreign investor invests in Indian securities, obviously that exemption to that extent cannot be given. And second is that the money of the investor, which is managed by the portfolio manager in the GIFT City, is credited to a bank account with a IFSC bank. So again, I think we might see some activity around this where portfolio managers will set up shop in the GIFT City to manage portfolios of foreign investors. In, let's say, a family house based in London, etc., wants to invest in different countries. That instead of being advisory, you can have a portfolio manager now which could be managing that portfolio. So an important development there. Moving further and sticking to the GIFT City, a few other changes. One is that today, if a foreign investor earns any royalty or interest or other income from leasing of aircrafts to a unit in the GIFT City, that income is exempt, and this has now been extended to shipping business also. So that's an extension of the benefit. And I found two other announcements which I think are very interesting. One is the setting up of an international arbitration center in the GIFT City. I think this can potentially give a strong competition to arbitration which happens for Indian parties in countries like Singapore, London, etc. As long as the framework is very robust, because of the fact that you'd be more based locally with an international law and maybe a lesser cost. And the other interesting development relates to foreign universities, where the government has now permitted foreign universities and institutions to offer courses from a GIFT City and free from any regulations such as the AICTE regulations, etc. I think again here there might be strong interest because, as we know, the student community is always mobile and can move to any location depending on where there are good colleges and universities. And if a strong international university sets up shop in the IFSC, I think this can certainly propel a lot of education activity within the IFSC. I will now spend a few minutes talking about some of the other changes, particularly on compliance and reducing litigation, etc. Maybe another 5-7 minutes or so. The first one relates to allowing taxpayers, both Indian and foreign, to file an updated return up to 3 years from the end of the financial year. Now, this has been done where, let's say, a taxpayer may have missed to offer certain income for tax and later on, the tax officer issues a notice or he detects it, and he could be saddled with a penalty and a risk of prosecution. So this is a benefit given by the government that if you missed offering something, you now have 3 years to offer that income to tax. Obviously, with a fine, you pay a slightly higher tax as compared to the original tax. But then if you want to reduce your income or claim a refund or claim a loss, this facility is not available for now. The second is on litigation management. Again, for those of you who might have undergone any litigation with the tax authorities on any issue and in appeal at higher levels like High Court, Tribunal, this is a very welcome development, because what we see is that in spite of getting orders in your favor, the tax authorities keep on litigating the matter at the higher level because they just want to keep the issue alive for finality at the Supreme Court. So now the budget amendment says that the tax authorities will not be allowed to appeal at the higher level if there's an order in favor of the same taxpayer or a similar issue in favor of another taxpayer. And the tax authority therefore has to wait for the final order and he cannot file an appeal. I think this will reduce the amount of queuing of litigation at courts, and courts are already quite burdened with litigation. So I think this will help to reduce some amount of litigation. And probably a few other changes, one relates to surcharge on capital gains. I think this is an important development for individuals and trusts and other investors who earn capital gains from non-listed investments. So now the surcharge on that gains has been brought at par with the surcharge on listed equity gains, which is 15%. So let's say if you have a long-term gain on sale of shares or other assets at 20%, with the surcharge, the rate becomes almost 28.5%, 29%. Now with the reduction in surcharge, that rate would drop by 4 or 5% to about 24%. So relief for investors who earn gains from investments in startups, from manufacturing, from any unlisted investment, from ESOPs and things like that. And then on crypto, I think most of our speakers have mentioned. I will just say a few, share my few thoughts on that. One is that the term virtual digital assets in the tax law has been defined very broadly to not just cover cryptocurrencies, but any other digital assets which may be identified by the government, including non-fungible tokens or NFTs, which are slowly becoming very popular, especially in the art world and in the sports and film business. The taxation here is almost at the highest level, 30% tax, with no deduction for any losses, any other expenses, excluding the cost of acquisition. And even if you gift crypto to someone else, there's a tax on that. But of course, the framework today does not allow you to use a crypto for buying for commercial purpose. So let's say buy an asset, a car or other goods. And so there is no taxation framework on that. The tax law is silent on that aspect. Plus, there is a need for a withholding at 1% when the person who's paying you that income it has to deduct tax while paying you on the redemption of crypto. To my mind, this probably could be an indication of some softening of the stand on cryptos. But I must caveat as a tax professional to say that under tax law, the government is allowed to tax even illegal income, such as money laundering or any other kind of illegal income, and there are Supreme Court rulings on that. So I would take it with a slight pinch of salt, but it does probably indicate that there might be some leeway around allowing investors to buy crypto. While talking of these changes, I'll just remind you and spend a couple of minutes before I hand it back to Viraj in terms of what changes we did not see and which were represented by the community to the government. So one is that FPIs, when they invest in REITs and InvITs, earlier they used to get a 5% withholding on interest income. That became 20 when REITs and InvITs units were included in the definition of securities under SCRA. There was a representation to bring it back to 5. That did not happen. And then there has been a representation for the last 3-4 years to allow for common treatment of all kinds of offshore funds, and also for restructuring of funds outside India to provide some tax exemption there from this Vodafone tax. But we have not seen any changes. But I think what is interesting is that the government has announced a panel for the framework of for private equity and VCFs, and VCFs now have been replaced with AIFs. That to me sounds very interesting, because I would expect that this panel will provide a completely new framework. Maybe they will just reclassify private equity similar to FPIs as a separate class of assets. And there have been a lot of pain points in the industry with respect to carry taxation, with respect to problems in listing of their underlying investments into India, and various other issues. So maybe all of that could be considered by this panel while laying down this framework. So pretty interesting development, along with the fact that we now see a lot of private-public partnership in private equity. The NIF is a great example of that. A couple of other recommendations, Euroclear bonds, I think someone did mention. I would expect that once the issues at the government level, there's been some indication about that, are ironed out, we will see an exemption for offshore Eurocleared or offshore cleared government bonds, because that is needed for inclusion of India into the global indices. So that might come later this year. And the other thing, the last thing which I just want to mention is that on buybacks, there still is an anomaly, in the sense that while dividend distribution tax was removed, on buyback there still continues to be a distribution tax, which means that the investor, especially a foreign investor, does not get a credit for that tax. And there could be a potential double economic taxation, because when A investor sells the shares to B, there's a capital gains tax. And when the shares are held by B and the Indian company does a buyback, there's again a tax on the same income. So that hopefully in the next budget or so, there might be some amendment. So with that, I think this is a brief little package on the regulatory and tax changes, and I'll hand it over back to Viraj. Thank you.
Thanks, Rajesh. That was quite elaborate. I must say that hardly leaving any chances for anybody to ask questions. So I hope all the questions on tax are taken care of. But nevertheless, coming back to our Q&A session, and after those very lucid, very extensive, very deep, incisive, insights that our speakers have given, we also have a lot of questions which have come. In the interest of time, as well as in the interest of the attendees, the speakers have said they are willing to make some time to take on this question. So let me take the questions. So Dr. Ghosh, then Srini and Nathan, if you could comment on this question. What is important to boost economy, IT concessions, or increased infrastructure expenses? What will boost the economy? You want, Dr. Ghosh, you're on mute.
Yeah, can you repeat the question, please?
Yeah, so the question is, what is important to boost the economy? Is it IT concessions or increased infrastructure expenses?
Increased infrastructure expenses, always. So there is no doubt about that. We may be, at the end of the day, we all crave for tax exemptions. We understand the compulsions, but please note that India's taxation starts at higher than its per capita level. No other country in the world had its India's income starts at taxation tax at 2.5 lakh, and your per capita is 1.4 lakhs. So that's the one. But the problem is India is that taxing sections of some communities are actually politically sensitive. We have seen that, and I think it's difficult to breach that bastion. So what we can say is that ultimately at the end of the day, the entire tax burden comes on the salaried person. It's true, we are also salaried players. We have shared the same feelings. But let me share a good news before you. I think the way the GST collections have been moving, the way the government has plucked the GST compliance, even in the most worst of days when the economy was devastated by second wave, the GST collection crossed 1 lakh crore. 1 trillion. Today it has cost 1.4 trillion. So I hopefully if it crosses 1.6 or 1.7 trillion, I think you can expect some tax concession from next year. So that's the message which the government has also given, and I'd also like to give. So I think we are moving in that direction, and that will be good for all of us.
Yeah. Any views from you, Srini and Nathan?
No, I think it's a very clear view. If given to me, I would say both, but both is not possible. We don't have the liberty. But like Dr. Ghosh said, I think eventually you would see tax compliances go up and hopefully concessions also start coming in. But at this point of time, we don't have the luxury of giving, taxation reliefs. And investing in the future, investing for growth is very critical.
Nathan, do you want to comment or?
Certainly, but quickly, because I'm very much aligned with what has been said by Dr. Ghosh and Srinivas. The infrastructure is an indispensable program, budgetary approach in all countries, and sets foundations for any nation. And the concessions are a lever that can be used by any government as well. It's certainly a matter of balance, but all in all, I guess that infrastructure programs would be more having a higher weight in the impulse of an economy.
Good, thanks. So I'm moving on to the next question. Again, Dr. Ghosh, Ravi, and Srini, if you can comment on this. The question is, does the budget indicate the future of crypto and digital money in Indian economy? And how will these shape the future of India in terms of growth and stability?
No, I think, let me answer that. I think digital currency is a very good idea. Perhaps India could be one of the first countries to introduce digital currency on a mass scale, because most countries are doing it on a pilot scale. It's a good initiative. And as I have said during the course of the presentation, whatever you hold is everything is actually in digital form, because when a bank keeps its reserves with the Reserve Bank of India, it doesn't go and keep the currency in its chest every year. So by that logic, everything is digital, and digital will only mean that it will be a seamless transfer. You will have some sort of a token or whatever at the RBI decides, and that could actually be also helpful. The most important thing is that it could actually help remittances across the borders. Of course, it should be not banks actually. It could be a little negative for the banks in terms of financial intermediation and the fact that the remittances that is given, but the banks can also equally benefit from business opportunities. For example, the banks can always introduce wallets to capture the significant amount of digital money that could be done. But I am very excited because at the end of the day, maybe 20 years down the line, when our son and daughters will be having nothing in their wallet, but only a digital token, or they'll just remember some numbers whereby they can transact. So it's an exciting one. Let's hope that we can embrace it in a staggered manner without any major disruption.
Thank you, Dr. Ravi. Anything you would want to add on?
No, I think that's Dr. Ghosh gave an overall view of what digital currency will do to the economy. Purely on the question also talks about whether taxing digital currencies and the income from digital currencies at this stage is an indication that of the regulatory structure. Revenue Secretary is on records to say that they just are taxing it and they have no opinion, and then that will come from some other department. So we just have to wait. Obviously, there are significant differences within the policy framework as to how exactly or whether they should be allowed or not allowed. So multiple views are there. But anyway, CBDCs are the way forward. I'm sure that has been announced in any case.
Srini, you want to add or?
No, I think this is a subject all of us are following closely. CBDC is an interesting point. The question today is CBDC's format of decentralized versus centralized. That needs to be now kind of solved. Private blockchain versus a public blockchain. these things have big debates globally. These are being discussed. So I'm assuming Indian government has been very wise the way we've done UPI and the other digital adoptions. And I'm assuming we will also innovate here, and we will try and be first and best in class when it comes to CBDC programs. The impact of CBDC is significant, like Dr. Ghosh said and Ravi also said. The significance of that is very large. But yeah, but probably you will see this in maybe 3-4 years from now, and not right away. But it's a good point to be starting and having a global presence. A currency which is of global stature, which is of digital in nature, will have other benefits too. Before not just the local transaction capability, it could also become a transaction medium for some of the global trade, if that can be used in a geopolitical way too, if done very well. So I think I see a lot of legs for this program. I think it's very interesting that the RBI and government is taking very big initiative and pushing, even though they know there's a lot of limitation around this. Giving up some of these freedoms is not easy for any bank or any government, but it's a very progressive move, I would say.
Thanks, appreciate it. Rajesh, I'll pose the next two questions to you. And the first one is, any tax incentive on individual or for salaried person you could?
I think good question. I think that was a big demand and expectation, because the government's collections have improved in the last 1 year, 15 to 19% increase in the collections. But I think, as Dr. Ghosh rightly mentioned, and I must add one more statistic to that India's tax to GDP ratio is still one of the lowest as compared to the OECD benchmark, about 8 to 9% compared to the 20% benchmark. Part of that is responsible for, not taxing agricultural income. But if you look at from that perspective, the government has its hands tied up on giving concessions to middle class and lower middle class, even though there have been some pain points for them, especially in sectors like tourism, etc., where COVID has a big impact. But I think the government probably had its hands tied on that and couldn't give much concessions.
Moving on to the next one, capital gains for startup exits.
Yeah, that I think is a merely an extension. So what would have expired for startups to claim exemption if they set up their units before March 22? Now they have 1 more year to set up units for their companies by March 23. In order to get this 3-year tax holiday, you need to follow certain policies around that. You need to be recognized as a startup with the ministry, and after that you can get your tax holiday for 3 years. And there are some other benefits also in terms of loss, carry forwards, etc. But the current budget has extended that benefit by 1 year.
Appreciate, thanks. So it's good to see the next question is interesting to see one on the GIFT City as well. And Ravi, and again, Rajesh, you can jump in as well. The question is, FPI and NRI wrote their trade through GIFT City, to get more tax benefits. As also earned, the question is slightly unstructured. So I'll just read again. FPI and NRI trade route through GIFT City will be to get more benefit, tax, and also major flow of FI and NRI funds through AIF, and what percentage of funds allow in SMEs. So it's a little confusing question, but I guess the question primarily is, what are the benefits if FPI and NRI come through the GIFT City?
So obviously, GIFT City regulatory framework is much simpler. For coming on to onshore, international investors have to register with SEBI as FPI before they can start investing. Whereas in GIFT City, they just have to get the KYC done through a proper intermediary, and they can start investing. So the ease of onboarding is significant, and we expect this will will be further relaxed as we go forward. International financial services centers across the world offer omnibus accounts, multiple other ease of access businesses routes. So we expect regulatory authority in GIFT City further reduces the access issues. While it is already simple, the other is obviously tax related issues. You don't have STD, you don't have stamp duty, you have multiple other benefits if you're coming through the GIFT City. So that is already available, and the product suite which is available in GIFT City is by and large on par with onshore. Other than the Indian equities, you get almost everything else, and the product suite is consistently increasing. We intend to we see as we go forward, there will GIFT City will be the staging point for almost all green initiatives. SME, there are lots of interesting AFs and fund ideas which are coming, which are actually trying to route their funds through GIFT City into India for SME financing as well as SME equity as well as debt.
Yeah. Rajesh, any quick ones?
Yeah, quick one. The question referred to AIF, NRI, and GIFT City. So I'll combine FPI. I'll combine all of that. If you set up an AIF and which also has to be an FPI in the GIFT City, with NRI or non-resident investment, from a tax point of view, the biggest advantage is that the income which that AIF or FPI earns from domestic investments, excluding shares, so derivatives, bonds, from GIFT City securities, and from offshore securities, is completely exempt from tax. And this is probably better than what you would achieve by investing through some of the foreign jurisdictions. So that is one clear advantage. And therefore, in the last 1 or 2 years, we have seen a very good amount of interest, decent interest from Indian managers and managers based regionally in setting up a fund in the GIFT City for doing long-short strategy for pure derivatives, which otherwise they were skeptical in doing domestically. So that is a clear advantage. One important consideration is that a lot of these Indian managers end up attracting NRI investors and not institutions. So since the GIFT City fund will be an FPI as well, you have to ensure that there's a cap of 50% on NRI investments, and the rest should come from non-NRIs.
Right, and just to add to, I'll be very short on this one as well. Our own study at TSAG and Pivot has been that GIFT City now ranks 76th in the world on the ranking of IFSCs, which is a very remarkable development for something which has just been 5-year-old into operation. Now, GIFT City should also be, there are 7 or 8 parameters across which you generally consider the competitiveness of IFSC like GIFT City. So when you look at Luxembourg, look at Ireland, look at all these things, the GIFT City authorities actually have, and IFSC, including the government, has made rapid progress on the technology, governance, regulations, trying to bring in products. So in the years to come, obviously, this will be one of the very critical and most attractive inflow centers. And that's where a lot of institutional investors will probably start looking at it. So I'm moving on to the next one, which is how is budget for capital market long-term and short-term? Which sectors are more beneficial? Rajesh, this could be for you and Ghosh, but just for attendees to know, this is not an advisory sort of a webinar. So the questions are to be taken at a very broad level. Rajesh, do you want to go first?
Yeah, maybe I'll stick to from a regulatory and tax point of view, and Mr. Ghosh obviously will have much better, interesting insights. The budget did not have much, changes from a capital markets point of view. A few things, though, which I found interesting is, and I did a brief mention, is on this framework for private equity funds and AIFs. And I'm keenly looking forward to that because this is an industry which is growing quite significantly. We see a lot of huge investments coming into India. Reliance Jio last year was a big example. And the government is keenly watching this and taking a notice of private equity investments coming into India. So that framework, which once it is laid down, I think will give a further impetus to investments, particularly in sectors like infrastructure, where private equity funds are saying, give us also the tax exemption which you're giving to sovereigns, because we'll make a huge investment in infra. So I think that is one key takeaway on capital markets.
Dr. Ghosh, anything?
Yeah, I think the good thing is that there has been a significant participation of households, retail participation of households in the capital markets, and that is basically become a self-fulfilling prophecy. And if that is the case, I see that the future for the capital markets in India looks very bright in the future, because there has been, of course, a fundamental shift in the behavioral shift of the households. I have said to that in the first slide that 7 trillion amount of money was the increase in household financial savings in the last year. Household financial savings, I believe a large part of that could have gone into the equity markets. I will give you one data over here before I stop, is that the total equity and mutual fund exposure of a typical Indian household is 2.5 trillion. You know what is the figure in USA? It's 333 trillion. So I think there is a distance to travel, given that total India's savings is around 70 lakh crores, 70 trillion.
Thank you. Sri, what do you think are the budget impact on mutual funds?
Yeah, I mean, so there is no direct impact on mutual fund, because there was nothing that impacted the taxation or anything else on the mutual fund, except for one bonus stripping on the REITs and InvITs part of it. That was kind of, Rajesh explained that. Beyond that, from directly, while there is no taxation impact for investors, like Mr. Ghosh said, the participation in the capital market by retail investors through mutual funds is a big positive, and that will continue to grow. The overall growth-oriented budget and the digitization are something that the government being pushed is also something that will help the mutual fund industry. But I think capital markets doing well overall will automatically help the mutual fund industry. There has been one dampener on the fixed income side because of the borrowing program that I think is temporary. I'm assuming in the long run that will also get ironed out.
Thanks. I have a very generic question, but it can be answered from an India perspective as well as a global perspective as well. And Ravi, this is to Ravi and Nathan. What do you think are the benefits of capital market? I know it's a very generic, very basic. One can keep talking for hours or days, but if you can be brief so that...
Yeah, better capital allocation. I mean, if the markets are expected to ensure the capital allocation happens the most optimal way, so that the economy benefits as a whole. That's a theoretical answer. But for investors, obviously, there's enough. I mean, when investors start investing into capital markets, and particularly equity side, they can have a balanced portfolio, fixed income plus equities. Dr. Ghosh mentioned about number of investors who are coming in. In India, we have just crossed 5 billion investors recently. So it's a big-ish number which has moved. It almost increased by about 40% in the last 2 years. And considering we are about 1.3 billion people, about 50 million is not a big number. So over a period, I'm sure these numbers will continue to increase. But capital markets as a whole will give you the best possible capital allocation, and that will give the indications for entrepreneurs to decide in which sectors they have to put money and ensure that the capital available is optimally utilized.
Nathan?
Yeah, it's at the same time such a deep question. We could stay speaking about that during not hours, months of classes, and at the same time very clear to me to answer in a nutshell. I am not aware of any country, be it advanced economy, emerging, frontier market, that have not acknowledged the importance to have an as efficient as possible capital market. It is at the basis of economic organization of any country, of wealth creation, of wealth distribution, of ability for people to invest and save safely. So for me, the benefit of having a proper, well-organized, clear capital infrastructure, capital market infrastructure is massive, fundamental.
I think, thank you. I think that's motivating to lead to the next question, which is also, how will this year's budget benefit the capital market? And, Dr. Ghosh, Ravi, Srini, y'all can take it up. How will this year's budget benefit the capital market?
No, I think we have already said that it's a continuous process, and given the fact that budget is futuristic, it has significant focus on the infrastructure sector, which is a multiplier effect of the economy. The equity markets is already forward looking. There will be some pressure on the debt market because of the borrowing, but as time progresses and the market understands that the budget is also a step in the direction of fiscal transparency, I think the market will reward such fiscal transparency in the future. So I am very hopeful of a positive movement in the capital markets in the coming future.
Yeah, I think that's the way forward. The investments which are going into, significant capex investments and the virtuous cycle kicking in, the economy as a whole is going to move forward. And if economy moves, the markets move. Markets move, people make money.
Srini, anything?
I can't add anything more than what Mr. Ghosh and Ravi mentioned. But as part of a market, I think there is already the momentum that is already in the capital market is definitely attracting more investors to take that market risk and come to it. That's a good sign. I think that sign will make more investors happy in their asset allocation, hopefully wealth creation in the long run.
Yeah. Dr. Ghosh, there's a very interesting question you may want to just share your views on. And the query is, FM mentioned crowd in of private investment. Don't you think that with higher public spending, crowding out may happen?
No. See, this depends on the typical macroeconomic condition. Currently, the fact that the economy is operating with a capacity slack, the capacity utilization rates are still lower than 70% in some of the sectors. So in a situation when the economy is actually capacity constraint is a factor, I think that crowding out hypothesis will not hold. But as the economy demand picks up, if demand picks up in the future and the capacity utilization rate goes up, obviously the argument of crowding out will kick in. But for the time being, I think more infrastructure invest in a situation of lower capacity utilization. Standard economics says that it will lead to crowding in of private investment.
Thanks. Dr. Ghosh, I know you've answered it in your presentation or walked through the presentation, but still there's one which has come. Do you think the budget has delivered on boosting consumption in near future?
See, I think if you ask me very honestly, I think in the short term, any budget which has a futuristic vision and which, when the economy has gone through 2 years of devastating pandemic, we must realize that if something was given to the people, it would have been made all of us happier. But that would have been a short-term phenomenon. So from that point of view, I think the short-term consumption may not get an immediate boost. But at least what we need to understand is that it's a budget for the long term. It's a vision for the long term. And you can only, what is important now is the execution, because at the end of the day, better execution will only keep the middle class happy and not better, giveaways, because because at the end of the day, India has to move forward. And one point I would like to feature over here is that, as I showed in the presentation, is that when the second wave happened, the devastation, there was visible and palpable impact of devastation across India and across the entire world. No country, every country has faced the wrath of the pandemic, and every country has suffered, including India. All countries, even in developed countries like Japan, even they have countries. So, but the good thing is that in the third wave, consistently we had 3.5 trillion cases every day. But can you have ever seen any report which shows that the people actually had to go to hospitals? I had not seen any report. So that shows that the wave has come, wave has gone, the wave has come, the wave has gone, and therefore we should look for the future. So if you ask me, yes, but I think that's a definite purpose.
Thank you. I think in the interest of the time, I'll take one last question. I'm sorry we will not be able to accommodate the many more questions. And I'm sure these questions are coming given the interesting insights provided by the speakers. But definitely all of them will be answered through mails, etc. So one last one, but a critical one as well, is again, how do you see interest rate hike from here? Srini and Dr. Ghosh.
So as a fund house, we have this view that looking at all the global liquidity drying and the kind of borrowing program in India that's coming up in the next couple of years, we don't expect interest rates to at least moderate. We expect it to further go up in the next couple of years. So the 10-year in the new year could be between 7+ to 7.25 kind of range. That's our fund house view. So Mr. Ghosh can add more.
The final word.
And I don't have any final word. I think just wait for the future. The future is bright, and let's move forward.
Right.
I will have to leave. I have to just have a meeting in place. Okay.
Thank you, Dr. Ghosh. And with this, we'll stop the Q&A session. Thank you, Dr. Ghosh, Ravi, Srini, Nathan, Rajesh, and Mrs. Uma. I now hand it back to Mrs. Uma for the vote of thanks. And thank you again, SBI-SG, for inviting me to moderate.
Thank you so much, Viraj. It's so nice. I was just thinking that budgets are like this. We budgeted for 90 minutes of this webinar, and we have, I think, crossed by almost close to 30 minutes. So it's only understandable when governments draw their budgets and run the national economies, and that in the backdrop of these VUCA circumstances. If they run up a little more fiscal deficit than budgeted, I think we need to understand that. It's my privilege to have been the host of this webinar on behalf of Team SBI-SG, and to have a very distinguished panel of speakers associate with us at a very short notice. I trust that the deliberations at this webinar are useful for the audience. I place on record a sincere appreciation and gratitude to Dr. Soumyakanti Ghosh, Group Chief Economic Advisor of State Bank of India, Sri Ravi Varanasi, President and Chief Business Development Officer, NSE, Sri R.S. Srinivas Jain, Executive Director and Chief of Strategy at SBI Mutual Fund, Mr. Nathan Derry, Head of International Coordination at SGSS, Mr. Rajesh Gandhi, Partner Delloitte, and our host, our moderator, Mr. Veeraj Kulkarni, Founder, Pivot Management Limited, and CEO, TSS AG. And I thank all our distinguished guests who have joined us from various locations across the globe and encouraged us. I know that there are a lot of questions which remain unanswered. We will be hosting the recording of this webinar on our LinkedIn site. I would request you to visit. If some of you have missed in parts, you can please go through that in detail, which I will be doing myself. And you can raise questions there as well, and we will be pleased to provide the answers there. Hopefully, we will host it on the YouTube as well. So I would request you to visit our YouTube link, which will be shared with you on your emails. And the LinkedIn link also will be shared with you. Please feel free to communicate with us on those links, and any questions there can also be taken up. Thank you all so much, and stay safe and stay healthy. Thank you.
Thank you.
Thanks, Uma, for calling us. Thank you.